Good morning. Mike Brady with Generosity Wealth Management speaking to you from Boulder, Colorado. Hopefully you had a very nice Thanksgiving weekend. Today I want to talk about the Fiscal Cliff. Perhaps you've read or heard about the Fiscal Cliff and have wondered, what the heck is it? I mean, they seem to talk about it like it's so obvious what the implications are. And I thought I would take a step back with you and talk about the origins, kind of what the Fiscal Cliff is, but also what are some things that we can do between now and the end of the year, and also what the implications may be for the stock market. Let's start off with the beginnings. Back in 2001, there was a pretty much across the board reduction in income taxes from the lower rates to the higher rates of about 3%, give or take. And at that time, there were also child credit increases, which was a good thing. And this was all renewed in 2010. It was supposed to expire in 2010. At that time, the Obama administration, with the Democrat Senate and House of Representatives, extended it for another 2 years, and that 2 years is coming up. So when it's described as the Bush-era tax cuts, at this point, it really, I would say, is the Bush and the Obama, because there's really both sides of the aisle have either started it or extended it. And so at this point now, both parts really, both sides of the aisle want it extended as well, but they're disagreeing about how to extend it, to whom it is extended, and which parts of it. What does this really mean? Well, from an income tax point of view, pretty much across the board, from the lower income tax rates all the way up to the higher ones, it's going to go up about 3%. Okay, and I'm going to throw up a graph there on the video, and you're going to kind of see how before and after it can go up. In addition, capital gains are going to go from, if you're at the very lowest, it's going to go from 0 to 15, or from 15 to 20% on capital gains. Dividends are going to go from 15% all the way up to whatever your marginal tax bracket is, which could be 39.6 if you're in the very highest. Your payroll tax, 2 years ago, in addition to extending the tax cuts, they lowered the FICA tax that is charged to the employee. So it went from 6.2% down to 4.2%. Well, that would be reversed. So 4.2%. So basically an extra 2% tax for those that are, W-2 employees, and all people who pay FICA tax, or whether you're self-employed or a W-2. And but also from an estate tax point of view, I mean, right now, estate taxes are 35%. To the amount in excess of $5.12 million, the amount that's excluded from estate taxes. If this isn't resolved in January, it will be the amount over $1 million per person will be at 55%. So it would go from 5.12 at 35 to $1 million at 55%. And $1 million sounds like an awful lot of money, but once you start adding up life insurance and your house and your retirement accounts, it's actually very easy and quick to get over $1 million. So this is a huge impact for a significant number of people. Now you might ask yourself, who cares about all taxes, whether or not they're higher or lower, etc.? And the argument, and the reason why this is such a big deal, is when taxes are raised, that's usually a decrease in production of some amount. And so the question is, although for each dollar there is more of a tax, in my example, in what right now we're talking about 3%, there might be less productivity in order to charge it on, so that your net after tax is actually less to the Federal Reserve, to the Federal Treasury, than you had before. And so both sides of the aisle ultimately want the tax rates to be lower, because they believe that it will hinder the growth that has been happening most recently, and harm the recovery that we're seeing some legs under right now. So both sides want it. The question is, to whom is the reduction or the extension really going to be applied to? Is it going to be applied since the reduction was across the board? Is the reduction across the board going to stay? Or are some, the very highest, going to allow it to be elapsed, and so their rates go up when everybody else's gets to stay the same? And so that right there is where a lot of the compromise is going to happen in the next month or so. Now, let's talk about what could happen. I mean, essentially, number one, they could let it lapse. I don't think that's very likely. Both sides want something to happen. Congress has a tendency to work well when there's the pressures on and when the public and when the media is putting so much of a spotlight on it. They could extend some, but not others. That's possible. That's absolutely possible. And as a matter of fact, I would even argue that that's more likely. Either some to all is going to be extended. The last is a overhaul the whole tax code, and that's great, wonderful thinking, but it's not going to happen. So, what does this mean for the markets? Okay, remember about a year and a half ago, the AAA rating of the U.S. government was downgraded, and at that time there was a huge decline in August and September, getting a little bit into October of 2011. There was a huge deal by S&P, or was it Moody's? I can't remember. One of the two, basically saying that they felt that the deficit was getting out of control and that we didn't have the political will in order to solve it. This would be another further confirmation that that assessment a year and a half ago was actually true. And I think that would be a very bad thing, okay, if we are not able to get this resolved. I still believe, and you've heard me the last, 9-10 months or so, feeling strong about the underlying fundamentals of the private sector, of the corporations, etc. Although we have a kind of a jobless recovery, the efficiency and the profitability of some of the corporations are great, and I'm feeling very optimistic and positive about that. This is a huge drain on the full economy of the United States, and of course on the world, since we're the world's largest economy. And so I do believe that the market would go down. There's going to be a reaction to it. The question is how long that would be, and how whether that would be temporary or whether that would be permanent. And if it does go down, I'm believe that it would be a temporary thing, because the underlying fundamentals I still feel strong about. A year and a half ago, let's not forget that the markets went down in August and September, and they actually had a very nice rally after that. We got rid of some of the people who got scared, and so those of us that were still invested in October, in general, in an unmanaged stock market index, did very well in the 6 months following, and I think that this would be potentially a temporary downturn as well. We still have a whole month before now and then, and it's been hard to try to guess what the federal government's going to do and our particular politicians. What can you do between now and then if you believe that tax rates are going to go up and then it's not going to get resolved? Basically, you try to do more taxation in this year. You can sell those assets that have capital gains. You can reposition your assets. If they're dividend-paying stocks, they can go over to maybe reposition those in IRAs or things of that nature. You look at your bond issues, and maybe it makes sense to go into municipals or tax-frees or something that's not fully taxable. There's a number of different things that you can do. If this does occur, and what can we do in 2013? Absolutely, we should consider the estate tax, and at that point I'll be talking with many of you to ensure that you have your estate planning and your estate planning attorney have really reviewed your particular situation as it relates to estate tax, with various types of trusts and other things that you can do to try to minimize the very high estate tax that you might suddenly find yourself find yourself. So anyway, that's the Fiscal Cliff in a few minutes. In a few minutes, I think probably turned into an even longer time, maybe even 10 minutes, which is a longer video than normal, but this is your summary. Mike Brady, Generosity Wealth Management, 303-747-6455. Hopefully I can help you out. If you're one of my clients, of course, I have an ongoing conversation with you. If you're not one of your clients, you want to give me a call, go ahead and do so. 303-747-6455. My pleasure to talk with you. You have a great day. Thanks. Bye-bye.